Hi everyone, this is Jathu here, and today I want to talk about the 4 key factors that you need to consider when you buy an investment property in 2024. Now, these 4 key factors will clearly determine how your property investment journey is going to perform over the next few years. So watch till the end because you will get a lot of value from it. Now, before we go into the video, I want to introduce myself. I am a buyer's agent for property investors, and I help investors buy in growth markets around the country where you will get good capital growth over the next few years while getting a very healthy rental income coming from these properties as well. So if you want me to handle the whole process for you, go to my website propertyframeworkbuyersagency.com.au and book a session with me there. Now, back to this video. Let's dive into these 4 factors. So now factor number 1 is knowing when to enter and exit the market. So this means that you know when to buy a property in a market, and you also know when to sell a property in the market. Now, the traditional approach tells you to buy a property and hold it through all the market cycles, through up cycles, through down cycles, pretty much hold it forever. They tell you not to sell the property because of high capital gains tax, high stamp duty when you buy another property, and so on. But if you hold on to a property ignoring market conditions and keep it for a really long time, then you will find that over the long term, the property will only give you an average outcome. And therefore, you should know when to sell the property when the market condition changes. So that means you're buying the property when market conditions are good, and you're selling the property when market conditions are not that good. Okay, to illustrate this point, I want to give you an example. Now let's take 2 people, John and James. They're both buying 300,000 properties. Let's see how their scenario plays out after 14 years. Okay, so now John is buying a 300K property with a 10% deposit. Right? He buys into a growth market. So after 7 years, the property has doubled and it's now valued at 600K. However, after 7 years, the market conditions have changed. The market has stagnated and there's no growth happening in that market. But John ignores market conditions and continues to hold on to that property. The next 7 years, there's no growth on that property, and the property at the end of 14 years still remains at 600K. So you can see at the end of 14 years, John has 330,000 of equity in his property. Now let's look at person number 2 is James. Now James too buys a 300,000 property. He has a 10% deposit on that property, but James does a lot of research. He looks at the data trends in that market and he knows which market to enter and when to exit the market. So he buys the property and the property doubles in 7 years, similar to John, and is now valued at 600K. But James now knows that the market is slowing down, the market is showing signs of stagnation, and he decides to sell that property. So once he sells that property, factoring in the loan amount and the capital gains tax, the remaining cash he would have is 265,000. He takes that 265,000 and he buys in a different market. In that market, he spends 15,000 for stamp duty and he puts 250,000 towards another property valued at 300,000. And we're using 300,000 again because we want to keep everything standardized, right? And this 300,000 property over the next 7 years, now he's brought into a growth market, right? So over the next 7 years, the property goes up really fast, it doubles, and it then becomes 600K. So at the end of 600K, James has 485,000 in profit. So that's 600,000 less the amount of loan, which is 50,000, less the capital gains tax, which is 65,000. So you can see James has 485,000 as cash and John has 330,000 as equity. So that's actually equity. If he actually sells the property, he would have to incur capital gains tax, and the actual cash he would have was close to around that 270,000. So you can see there's a huge difference between both scenarios. So this means that if you can buy a property when conditions are good and sell it when conditions are bad, and then take that profit out and put it into another growth market, you will have better returns over the long term. So the key then is, how do you know when conditions are good and how do you know when conditions are bad? So when a market is about to pick up, right, look for these three indicators. Now, we don't want to look at it at a suburb level. We want to go at an LGL level because then we have more samples, right? So at an LGL level, look if the sales volume is increasing, the vacancy rates is reducing, and the supply trends are reducing. Okay, that's all. It's quite simple. And when the market is stagnating, you'll find the sales volume are reducing, the vacancy rates increasing, and the stock on market increasing. Okay, I want to demonstrate with an example. The city of Burnie in Tasmania. Let's look at what happened here and how you can time the entry and the exit of this market. So if you look at the city of Burnie here, Burnie was pretty much flat between the year 2007 all the way till about 2016, 2017, right? Something changed in 2017 and there were some early indicators there, right? So as I said earlier, the sales volume started increasing from 2014. You can see that in this chart here. And then we saw that the vacancy rates are also reducing from 2014. And finally, from 2016 onwards, we're seeing the stock on market reducing. It was only when the stock on market started reducing and all three of them were happening together that the property prices started surging. So that was pretty much the time to enter the city of Burnie, right? So how do you know when to exit? So the opposite will happen. So Burnie started stagnating around 2022. So what you can see is that from 2021, late 2021 onwards, the sales volume started reducing. The stock on market started increasing from late 2021 again. And you see that the vacancy rates also started increasing from late 2021. So all these signs pointed to a slowing of the market. So that means you would have made maximum profit if you entered the Burnie market just around that 2015 and sold around 2022, taken the profits out and put it into another growth market. Now let's look at a market in 2024. If you look at Melbourne, you can see sales volume increasing, vacancy rates reducing, but the stock on market has not started reducing yet. So Melbourne will start to pick up in price when you see the stock on market reducing, right? So these are pretty much the keys to identify how to enter and exit the market. Okay, now let's go to point number 2. Avoid markets that have had too much growth. Now, I've emphasized this in previous videos as well, and I want to illustrate this with a point. Now, let's say you have a marathon runner. This marathon runner has just finished 42 kilometers. He's run a lot. You go up to him and ask him to do another 21 kilometers. The chances are that he's not going to do it, or he's going to do it really slowly, or he's going to do about 5 kilometers and then stop the race, right? Because he's just tired. Whereas if you have a fresh person who's only done 2 or 3 kilometers, and then you go and ask them to do 21 kilometers, the chances are that they will do that 21 kilometers at a steady pace and be able to complete it as well. So it's the same with property markets. The property markets which have had a lot of growth are already tired. They just can't keep on going forever, right? So if you look at Sydney and Tasmania, Hobart, the city of Burnie, these markets have had a lot of growth over the last decade, and that's why they're slowing down. Whereas if you look at markets like Adelaide, Perth, Brisbane, these markets are surging forward because they performed really pretty poorly over the last 10 years, between 2010 to 2019. Some of them actually underperformed and were declining in value. So always look for markets that haven't had too much growth. Of course, we also need to look at those indicators which I spoke about. When those indicators start happening, then you know it's time to enter that market. Okay, so that's point number 2. And now we want to go into point number 3, and that is, don't always look at capital city markets. Also look into regional centers. In 2024, it's super hard to find a property, a brick home under 500K in a capital city. You're going to struggle. And therefore, don't ignore the regional markets, because regional markets will still give you that growth. And as long as you know when to enter and exit the market, it doesn't really matter whether it's a capital city market or a regional market. You can still benefit from that capital growth wave that you're getting. So I've done previous videos about which regional markets are looking good, so check those out. So when you look into a regional market, always look for markets with good economies, good interstate migration patterns, healthy infrastructure projects, and we want to observe those data trends in the positive direction. Okay, so that's point number 3. The last point is to continue building out a property portfolio, you just can't keep on buying in your own name. So point number 4 is look to buy under different structures if you want to continue your property investment journey. So I want to give a bit of background on this. In 2014, APRA introduced a serviceability buffer when they factored in borrowing calculations, right? So that means if you have an interest loan of about 5%, there was a 2% serviceability buffer on top, which meant that the banks will assess you at 7% instead of 5%, right? Prior to 2014, this did not exist. So which meant that it was more easier to borrow before 2014 and people were easily able to build out those portfolios. But after these changes, these serviceability buffers came in. It's now sitting as high as 3%. After these serviceability buffers came in, it's becoming increasingly hard for investors to keep on borrowing for more properties. And therefore, they will hit a ceiling at some point, right? No matter how good your rental yields are, you are going to hit a ceiling at some point. And therefore, look at other avenues. Now, this is not financial advice. Speak to a professional with regards to this. But if you can buy properties under a trust structure with a company in it, and then get an accountant letter saying that that entity can trade profitably, then the banks will ignore that debt on that property and you can continue buying other properties for a long time. So look at other structures. Don't always keep on buying under your own name. Okay, so those are the 4 tips that I can give you to buy really high quality investment properties in 2024 and continue your property investment journey. I hope you found those tips useful. Please like and subscribe to the video. If you found it useful, please comment as well. If you didn't like it, please put in your comments as well. And I'll see you in the next video.